Good morning and welcome back to Almus Market Mornings. The week started off with quite a bit of turbulence as investors in the US remained jittery over possible ramifications of tariff-related uncertainty on the US economy. Equities stumbled, the S&P down over 2.5%, Nasdaq losing close to 4%, but there was strong buying in the US bonds. The 2-year paper trading firmly below 4% towards 3.8%, the 10-year close to 4.15%. JK, seems it wasn't a good start for the week after the US opened. What's happening with the markets?
Good morning, Raj. Yes, it was kind of mini Black Monday, I would say. The way the stock, uh, crumbled yesterday in all the indices. In fact, even the strong European markets had to fall under the impact of the big sell-off in the US market. But what the market was looking at was some of the weekend statements when Trump, if was asked if he was expecting a recession, he did not deny it, and he was saying that I hate to predict things like that, but there is a period of transition that we are doing, and it's very big. So he was not saying that there won't be any recession. Similarly, Treasury Secretary had said there will be a detox period going forward. So market is reading this as a sign that the administration is okay with certain amount of slowdown in the economy just to achieve their broader goals, of balancing the um, deficits and also getting us into a more self-dependency on production and creating long-term more jobs and all that. For that, they probably are sending a signal that a short-term pain is what the economy will go through. And I think for the Wall Street, it was a big wake-up call. There has been a sense that the market has been overvalued quite a bit, and so it needed a catalyst for the fall, and perhaps these perspectives from the administration gave that green signal for the market to actually sell off and come to more reasonable valuations. Also, there had been a sense that President Trump is kind of measures his success on stock market performance. That was very clear in his first term in office. However, this time it looks different, and he's not really. He's actually saying that he doesn't look at those markets, and there is even a sense that somewhat of a Trump put. Will be there to the market. So market really nosedived. S&P at one point of time was down 3.5%, Nasdaq was down 4.7%, and Dow was at the worst minus 2.8%. If you look at it, Nasdaq, where the valuation concerns have been the highest, is now down nearly 15%, and all the three indices are now below the 200-day moving average, which is considered in technical parlance as a good support zone, but they have been pierced through with quite an ease. Apart from the statements from the administration, elevated negative perception about the eventual negative impact of tariff policies, layoffs, and cutting government expenditure has been behind the asset market sell-off. Investors are also present to the fact that the February employment numbers did not fully capture the impact of the drastic policy changes that have been introduced. And in the months ahead, we will see a weak job report, uh, depicting the clear state in which the economy is right now. No, under the impact of stock market, as you said, the yields also tumbled, 2-year breaking the 3.90 mark and 10-year trading below 4.2%. With the probability of US now entering a recession high under the perceived negative effects of the policies, the stock market and the stock market crash, we now have a near 80% probability of 3 rate cuts in 2025 and almost a 50% probability of a cut as early as May. Earlier, it was presumed that there will be only one rate cut, and the only one could happen perhaps in July. So that is the big change that we are seeing. And in fact, some even go to the extent that there can be suddenly a series of rate cuts if the market continues to crumble, and then big slowdown in the economy is pursued. That is something that even the administration welcome, a lower interest rate leading to further low in the yield that can reduce the cost of servicing their huge debt. Now, adding to the bearish sentiment, consumer year-ahead expectations of the household financials deteriorated considerably in February as per the data yesterday. And the share of households expecting worse financial conditions now was at 27.4%, the highest level since November 23. Unemployment expectations also worsened to levels seen last in September 2020. So this is suddenly a broad picture of you know, uh, slowdown and anticipation of further slowdown that is actually leading to this negative perception about the stock market and also the sell-off. But if you have to speak objectively, stocks have been overvalued, and as I said earlier, they were waiting for some catalyst to correct, and that seems to have arrived now. As for the dollar, the lack of flight to the dollar, despite this big sell-off and the risk of sentiment, is quite conspicuous by its absence. Even the worst affected currencies like Canadian dollar and Mexican peso were only modestly lower, considering what they are likely to face ahead in terms of tariff. Of course, yen has been an outperformer at low. I mean, at the low of 5 months. That is dollar yen at the low of 5 months at 146.62. Now, euro has been steadier. We have hardly had any meaningful correction in the euro, despite its near 5% rally in the last 10 days. And what is working here is the sharp narrowing of the yield difference between Japan and Germany and its US counterpart. Now, both have been at the lowest since in the last 6 months, and that is leading to the strength. Of course, euro has had its own share of positive news when the due to the debt break and all that. So I think. While the dollar has not reacted positively to the risk-off situation, if we were to see a dovish statement from the Fed or a dovish approach from the Fed in the coming weeks, then there's a good chance the dollar could tumble even more. Because let's remember that it has been, slightly from a broader perspective, it has been on the longest dollar bull cycle of nearly 14 years, and the market is structurally long positioned in the dollar, buying dollars on every occasion and all the news. And now we are seeing that that yields might come off further under the impact of the recession, and also possibility of more rate cuts than three, which I expect. So the dollar is likely to remain weaker. It is no more evident than even in the the emerging market currencies, which are held steady, which normally take a tumble when there is a risk of sentiment. Yeah, to speak of the rupee, of course, it was 45 paisa weaker compared to the Friday's close, 86.87 close on Friday, and yesterday traded a high of 87.33. But then it's all within the range, and we are not broken into a new high, not even attempted a break of 87.50. There has been a lot of imported demand, and also mostly NDF related unwinds, or rather the buyback of dollar that has been reported in the market behind this huge dollar buying. Yes, FI flow was still negative yesterday, but it was quite negligible. And exporters selling has been absent once again. But I still maintain that going forward in the month, we should see a bias for a higher inflows and also for a higher export coverage due to the year-end factor. Therefore, I think rupee is well capped at 87.50. And should there be a further drop in the US yields, and if there were to be further fall in the dollar index through 103 and towards 102 or 101, I think USD INR will also drop back to 86.50, which is at the lower end of the range, and perhaps more. It depends upon the flows at that point of time. Thank you.
Thank you, JK. And I think the summary was, as you mentioned, Trump put. So we are having strong sell-off in US equities. Bonds are also coming down. Maybe this is a strategy that the administration itself wanted, the short-term pain, which also results in interest rates falling, the yields falling, which is, of course, what they wanted, especially when it comes to the large amount of debt US is holding. One interesting thing, which again JK mentioned, was the lack of flight to the dollar, despite all these developments, because there was a strong risk of sentiment yesterday with the yields falling and stocks crashing. but there was no major move in the dollar, and it remains possible that further rate cuts and the fall in yields may put the long dollar trade under pressure. So that's a story we'll keep tracking. For rupee. There was rupee opened much weaker as compared to Friday's closing, remains range bound but there are reportedly NDF related trades which triggered the rupee weakness yesterday. But as JK mentioned, it should remain range bound with the upper side of the weakness limiting towards 87.5. That's it from us today. Thanks for listening. Have a great day, and we'll see you all tomorrow with a fresh round of updates.